Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders as always. Anyone who is registered for today's program will be receiving a copy by the end of this week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our good friend, Kerrigan Advisors founder and managing director, Erin Kerrigan. Erin, I'm going to let you take it away.
Okay, thank you, Rachel, and thank you everyone for tuning in to yet another Kerrigan Advisors AIADA webinar. Before I get started, I did want to share some exciting news on our firm's front. We just celebrated our firm's, Kerrigan Advisors, 10-year anniversary in March. And I just wanted to share, we appreciate our associate membership with AIADA since our founding and are so grateful to our clients, industry friends, and colleagues for your support and trust over this last decade. It is hard to believe that since 2014, not only have we published over 1,000 pages in 40 Blue Sky reports, but we have also led the industry on the sale of over 260 dealerships for more than $8 billion in client proceeds. Our team is very excited to see what the next decade has in store, and thank you for allowing me to share this important milestone. Now let's jump into this presentation today. As we experienced during the pandemic, this year, 2024, will present some challenges when seeking to forecast the quote-unquote new normal for auto retail, if we can ever find one. One thing is for sure, we continue to see a resilient, albeit adjusting, buy-sell market. You'll see I'm employing a women's basketball theme for today's discussion. I thought it only appropriate given the excitement of this recent tourney that we were all so glued to on the TV, which, like the buy-sell market, defied the odds. As Caitlin Clark prepared to hit an all-time record for points scored during a college basketball team, so too did the 23 buy-sell market, surpassing 21 in number of transactions completed, though not in number of franchises sold, notably. The first quarter of this year appears to show a continuation of this very active trend with a few more winners and losers, as I will discuss. Kerrigan Advisors has already sold 49 franchises in the first quarter of 24, a record for our firm, including the sale of Leith Automotive Group to Holman, the largest transaction ever completed in the Southeast in terms of number of rooftops. This acceleration in buy-sell activity is particularly surprising when considering some of the negative industry headwinds we have been experiencing since the beginning of last year, including the highest interest rates in 2 decades, making vehicles much less affordable to purchase and acquisition financing more expensive for buyers. Couple that with declining industry profitability, which is the bar chart here. We believe profit margins industry-wide have been cut in half since 2022. And yet it is perplexing to see that most dealers are still seeking acquisitions right now. Nearly half of dealers surveyed by Kerrigan Advisors plan to acquire one or more dealerships in 24, while only 6% are seeking to sell. Auto retail is clearly defying the broader corporate M&A market. In 23, the dealership buy-sell market increased by 6% to a new record, while the overall U.S. M&A market declined 30%. So what is causing this distinct anomaly in our industry? First, our view is that dealers are subject to OEM-imposed leverage limitations. These limitations create a ceiling on debt deployment and a bias against acquisition leverage. Today, given a large cash reserve on most dealers' balance sheets, most dealership acquisitions are financed with minimal debt and funded with equity, mitigating the impact of higher borrowing costs on valuations and buy-sell activity. Kerrigan Advisors estimates the industry has amassed nearly $250 billion of pre-tax earnings since the pandemic, almost 2.5 times the level achieved in the 4 years prior. The majority of this capital has yet to be deployed and remains on dealers' balance sheets seeking a return. Also, the average dealership debt to equity ratio ended 23 at just 0.77. That's 38% lower than the pre-pandemic averages, providing ample financial capacity for growth and limiting the impact of higher borrowing costs on buy-sells and the activity. The second reason that auto retail is defying the broader corporate M&A market is because of its distinctly private structure, which minimizes the impact of the public capital markets on transaction fundamentals. The overwhelming majority of dealerships are owned by private dealers still, with the average dealer owning less than 3 dealerships. The largest of the private dealers, those that are in that coveted automotive news top 150 list, represent just 21% of industry revenue and 19% of dealerships. While the public companies, the 6 publics in our industry, represent just 10% of revenue and 7% of dealerships. We are such a private market. Now, in most retail industries, the largest retailers command a majority of industry sales. For instance, Amazon represents nearly 40% of all e-commerce sales. The private, fragmented composition of our industry translates into a very insular buy-sell market, driven by internal rather than external dynamics. This structure is a consequence also of the barriers to entry imposed by OEMs, who set a high bar for franchise investment by new entrants, approving only buyers with a proven auto retail experience or an experienced operator. Also, these limitations by the OEMs place a very high bar for the largest consolidators, because the OEMs do have framework agreements for most of these large consolidators, which further curtails industry consolidation by the largest groups. Now, many private dealers do want to grow their enterprise because they are also well aware that they are uniquely positioned to expand with less competition from public and private equity buyers, and they know there are few investments that provide such high levels of return on equity. Auto dealerships ended 23 at a 34% average ROE, still above the pre-pandemic averages, even though profits declined last year. Now, given the dominance of private ownership in auto retail, it is not surprising to see that the publics once again represented a slim minority of acquisitions in the market. In fact, for the most part, well-funded private dealers crowded out public buyers in our experience in 23 and continue to do so this year, particularly as the public stock prices experience significant volatility. The Kerrigan Index rose and fell greater than 20% at least 5 times throughout 23, challenging the public's ability to price acquisitions based on their own stock price. This trend looks like it could continue through March of this year. The Kerrigan Index is up 36%, but has since fallen 13% in the last 2 weeks. The publics as a group ended the year at an average of a 4.6 blue sky multiple and are currently trading on average around that same level. Many of these companies are priced out of the most desirable franchises, those top franchises that can often trade at a 7 multiple or even higher in growth markets, and I'm going to talk about that towards the end of this webinar. The publics, as such, have chosen in many cases to allocate more of their capital to stock buybacks, since they're trading at such a low multiple, spending a collective $1.9 billion last year on buying their own stock rather than buying acquisitions. The lack of liquidity premium for these companies is further evidence of the private sector's dominance of our industry, as well as the public's growth limitations imposed by the OEM's framework agreements and Wall Street's pricing of their stock. Now, even though the public's allocated a great deal of their funds to buybacks, some of the public, specifically Asbury, were still relatively active in 23. They acquired 61 franchises for $2.7 billion, the second highest U.S. acquisition spending level on record, although 70% below 21's $9 billion. The only mega transaction completed in 23 was the acquisition of Kerrigan Advisors client Koons Automotive by Asbury for $1.5 billion. That's the third most valuable transaction in retail history and represented 55% of the public spending as a group. Kerrigan Advisors also wants to note that we were the only firm to represent the sellers of dealerships to the publics and in 23, selling 30 dealerships for a total of $1.9 billion, representing 71% of the total public acquisition spending last year. Now, our firm expects the publics will continue their judicious approach to capital allocation. Collectively, they have $7.6 billion available for investment. So, like the private sector, they have plenty of capital to spend. The key is finding acquisitions that work for their shareholders and fit into their strategic plan. In the first quarter, our firm represented on the sale of Triple R Automotive in Maryland to Group 1, so we are continuing to see these companies grow through acquisition, though, as noted, they do have limitations. Okay, now that we've discussed an overview of the buy-sell activity in 23 and a preview of what we expect for 24, let's talk about valuation trends. Like the surprise coming out of the NCAA basketball tournament this year when the women's finals beat the men's in ratings, past performance is no longer prologue for future expectations when it comes to valuing businesses, valuing blue sky businesses, that is. Now, historically, blue sky was priced based on the product of two key factors: a dealership's adjusted earnings and a blue sky multiple. Buyers typically looked at the last 12 months of earnings for the basis upon which they would value a dealership, increasing the multiple on those earnings if they expected there was upside in the deal. However, starting with the pandemic, it became very difficult for buyers to assess earnings, particularly when they skyrocketed to never-before-seen levels and remained at those levels quarter after quarter, much longer than anyone could have predicted. This forced buyers to make assumptions about where earnings would or could eventually normalize. That methodology for predicting normalizing earnings has evolved multiple times over the last 4 years, seemingly sometimes even quarterly. Now, as I mentioned, pre-pandemic, most dealerships were valued based on actual earnings, as you see in 2019. Sometimes buyers would average the last 3 years, but generally we found the trailing 12 months was the most common methodology and driver of blue sky value. In 2020, we started to see this whole methodology change. Buyers started to average, in some cases, 19 and 20. As the year progressed, they started just looking at 19, assuming that we would go back to 19 levels. But then slowly as the year progressed, we found that buyers started to do this averaging to determine how to value blue sky. In 21 and 22, buyers continued to presume some of the efficiencies gained through the pandemic would sustain, particularly increased OEM inventory discipline. That does not appear to be sustaining right now, and higher margins, though they were unwilling to assume all of the improvements were possible to sustain in the future, and that was a good assumption. They estimated on average of pre-pandemic and pandemic earnings as a potential new normal and used that number for valuation purposes. Again, discounting much of the current earnings. You can see the dark blue line is the actual earnings, average industry earnings, and the turquoise is what we often found to be used on average in valuation. Then came 23, when buyers suspected that averaging the prior years was really overestimating future earnings, particularly as profits started to decline in the second half. So rather than base their valuations on historical elevated profits, they began to project expected net to sales margins on a normalized basis, assuming maybe that net to sales would average between peak margins of 6% and pre-pandemic levels of 2%. Buyers then apply their projected normalized net to sale margins to current revenue to determine estimated expected earnings for blue sky valuation purposes. Now, as we enter 24, all of this averaging we find is going out the window. Kerrigan Advisors believes that most buyers now are once again returning to the tried and true method of actual earnings in determining blue sky value. Ignoring the anomaly of the pandemic and focusing on a dealership's current performance, what have you done for me lately methodology, believing that starting in the second half of 23, we are entering the great normalization period. Of course, 24's valuations will inherently place a greater emphasis on the industry's financial performance in the second half of 23 if we're looking at TTM as a basis, when profitability did decline an estimated 18% compared to the first half of last year. That, by the way, is the first such second half decline since 19. Now, this decline was primarily a byproduct of rising new vehicle inventories, higher interest rates, which led to higher floor plan expense, lower front-end gross profit margins. And of course, we also saw a rise in payroll as a percentage of gross and higher advertising costs per vehicle. Many buyers believe the second half of 23 and the first half of 24 are the best reflections of what we can expect for the industry going forward and are thus pricing their deals based on these numbers. It is notable to see that while we do expect blue sky values to continue to decline in 24 as they did in 23, this decline will not be as dramatic as the rise and fall in industry earnings, because for the most part, as discussed, dealership values did not give significant credit to the pandemic's peak earnings. For dealers considering a sale in 24, blue sky based on current earnings may seem extremely low relative to 21 and 22 profits. However, it is important to keep in mind that the benefits from those profits are retained. You get to keep them. They just won't factor in to your blue sky value. Okay, now aware that valuations are declining, Kerrigan Advisors does see a rise in sellers coming to market in 24, ready to cash in on generations of hard work as they expect the auto retail game may be changing. Many see themselves facing a crossroads to either grow their enterprise or exit, particularly as their peers with 5 or fewer dealerships decide to sell and their competition with 11 or more are on the rise. Also of note to us is that we really are seeing an acceleration in consolidation. We've seen that in the last 4 years, about 15% of dealerships have traded hands. And if we continue at that rate, then in 25 years, we will have seen every single dealership trade hands in this industry. Some are deciding to capitalize on today's blue sky values rather than assume the risks associated with growth, particularly in an industry facing tremendous change due to government mandated EVs. Also, some are concerned that proprietary technology could become a key ingredient to retailing success in the future. With the AI revolution well underway, auto retailing will undoubtedly see dramatic changes, making the pre-pandemic way of life a vestige of the past. Kerrigan Advisors believes some of these concerns are well-founded, as we see the most significant wild card for auto retail performance and valuation is the future of electric vehicle sales. The government drumbeat toward an exclusive EV world is starting to show signs of softening. However, the mandates are still too high and hard to meet, particularly as the marketplace rejects regulators' assumptions about EV demand and market viability. EV sales growth has plummeted since 22, with average days to sell an EV skyrocketing and EV used car prices plummeting. In many regards, the EV market has already become quite saturated. The owners of EVs primarily reside in major metro markets with built-out charging infrastructure. Many of these consumers also own an alternative ICE vehicle for long-distance travel, reflecting their higher net worth status and the need for an alternative to an EV to even own one. 60% of EV owners have an annual income of more than $100,000. Even in California, which dominates EV sales, EV buyers are becoming harder to identify, which is not surprising given the significant distances that most have to drive in California. I grew up in California and I can't imagine having to drive an EV to the different places that you had to go and hope that you could charge it when you got there. Given a more challenging EV marketplace, dealers operating in states that have signed up for the California Air Resource Board's limits will increasingly find their OEMs tested to meet the CARB EV sales thresholds required by state regulators. As currently planned, EV demand will determine total vehicle sales in CARB states in less than 2 years, when 35% of vehicles sold in those states have to be electric. Today, this target seems very aggressive given EV sales in 23 are nowhere near this threshold. It is notable that the most respected OEM in the industry, Toyota, does not expect global EV market share to surpass 30% and has chosen to acquire carbon credits rather than waste billions on a technology that will not likely become the dominant powertrain in the near future. With this in mind, Kerrigan Advisors sees more dealers in CARB states considering a sale, rightly concerned about the future of their operations and profits given ICE vehicle sales limits, which will certainly result in lower future profits and blue sky. Interestingly, CARB states also tend to be the lower population growth states, as you can see on this slide, with all but 3 growing at a rate below the national average, adding to the challenges of this requirement. Now, in line with these regional challenges, another distinct characteristic of the 23 buy-sell market is an increasing divergence in buyer demand for regions and franchises. Whereas over the last 4 years, rising earnings tides lifted all boats. Today, we are definitely seeing more winners and losers in the buy-sell game, particularly based on geography. Kerrigan Advisors analyzed the geographic breakout of the industry's consolidation since 19. Notably, there is a clear regional bias towards business-friendly, high-growth markets in the South, which is gaining even more momentum in 24. This region saw its share of the buy-sell market rise to 42%, more than double that of the West and Northeast in 23. Kerrigan Advisors sees buyer demand for dealerships in southern states continuing to increase in 24, particularly those markets with the highest population growth, strong franchise laws, and business-friendly climates. Now, consistent with this trend, if you look at the pie graph on the right of this slide, 87% of acquisitions made by the publics in 23 were located in the South, with just 11% in the West and 2% in the Northeast. No acquisitions were made in the Midwest, although you can see on this slide to the left that the Midwest actually gained market share with private buyers. Now, while many of the public's dealership groups are seeking a national footprint, their primary focus is on markets that have the most attractive economic characteristics, namely net migration and robust franchise laws to support their dealer networks. With this in mind, Kerrigan Advisors finds that franchises located in the highest growth MSAs continue to achieve record valuations, particularly top import and luxury franchises. These franchises are rebuffing the trend of declining valuations and usually are sustaining their peak earnings. Also, there are very few of them available to purchase because, for the most part, the top growth markets are already highly consolidated. This slide shows you the top 10 major metros in terms of population growth. You can see that 72% on average of the top luxury franchises in the top 10 fastest growing MSAs are already owned by the largest groups in the country, meaning just 28% on average are available for potential future purchase. Given the tremendous demand for these franchises relative to the very small supply available, these franchises continue to command record valuations, and we really don't see that changing anytime soon. Buyers are also becoming more choosy about what franchises they are willing to acquire, often only interested in the top import and luxury franchises and discounting all others due to their less attractive investment characteristics. Keep in mind, in 23, the top luxury and import franchises outperformed the broader market in new vehicle sales growth. And this outperformance is pretty secure when considering how few of these franchises exist, resulting in higher dealership sales throughput and a robust fixed operations business supported by the highest units in operation. Basically, a fundamentally better business model than the rest of the industry. Toyota and Honda, by way of example, have 1,200 and 1,000 franchises serving the entire United States, resulting in superior new vehicle sales per franchise, superior UIO counts per franchise. Likewise, the top luxury franchises significantly outperform their luxury competitors in this area, although I will discuss Mercedes more in a moment. It's important to also keep in mind that many luxury dealers own multiple of these top luxury brands, resulting in fewer available for purchase, just like we saw in the major metros. In the case of Lexus, for instance, Kerrigan Advisors estimates there are less than 150 Lexus dealers in the US due to multiple franchise ownership. That means the demand is high and the availability is very low, and that results in consistently high values. Okay, to wrap up our discussion today, let's discuss a review of the blue sky multiples. Like the brackets we all just attempted to fill out, tracking franchise valuations requires a great deal of analysis and can be difficult to predict. In our most recent Blue Sky report, our annual 23 Blue Sky report, we do our annual franchise review where we have a deep dive into each brand and provide a very thorough analysis and assessment of their valuation drivers. I do suggest you look at the report. It's 50 pages long. It just got published last week, thank God. And I'm happy always to answer any specific questions on that review. Kerrigan Advisors made several adjustments to our blue sky multiples and multiple outlook this quarter. Specifically, we increased Honda and Mazda's blue sky multiple to reflect continued improvement in sales performance and stronger buyer demand for these franchises. In the case of Honda, the franchise is regaining 22's lost market share, resulting in its sales per franchise increasing at the fastest rate of any OEM, to the second place behind Toyota, which is where it used to be. Also, Mazda sales rose 23% last year, nearly double the market rate, and continue to benefit from its captive partnership with Toyota Financial Services, which was extended for another 5 years, which is an important thing for Mazda. Mazda's blue sky multiple outlook is upgraded to positive as well. This quarter, Kerrigan Advisors did reduce the blue sky multiple for Nissan. Buyer avoidance of the Nissan franchise is very high, resulting in lower blue sky multiples. We would not be surprised to see Mazda surpass Nissan in blue sky multiple this year, despite the fact that Mazda actually has a lower UIO count and sales per dealership than Nissan. Buyers are more excited about the Mazda franchise and have more skepticism about the future of the Nissan franchise. As it relates to luxury franchises, Kerrigan Advisors upgraded BMW's multiple outlook to positive to reflect that franchise's outperformance last year, particularly with its success in the EV market, a bright spot for the EV industry, one of the few. We expect a future increase in the BMW blue sky multiples if buyer demand continues to rise and BMW outperforms the market again in 24. In contrast to BMW, we did reduce the high-end blue sky multiple for Mercedes last quarter despite some of the attractive characteristics of its overall franchise network, as I previously mentioned. The OEM did falter in its EV rollout, and Kerrigan Advisors is seeing a slight softening in buyer demand for Mercedes franchises in certain markets, not all, but in certain. The OEM is also one of the most aggressive in using its ROFR right, as it is really seeking to have an active role in trying to control and minimize its dealer network to a select number in each region. And that is having the effect of reducing a bit dealers' trust in the OEM. 14% of dealers surveyed in Kerrigan Advisors' annual survey had zero trust in the brand, and that's more than double that of BMW. We also reduced the blue sky multiple for Lincoln this quarter. Buyer demand continues to decline for Lincoln as dealers report concern about the OEM's EV plans and ballooning inventories. Lincoln ended the year with 140 days supply on average. To finish up this presentation and continuing with the women's basketball theme, while there may be more headwinds in auto retail, dealers, like the resilient women in college basketball, have always played the long game and proven time and time again that they have what it takes to succeed through hard work and determination, no matter what the odds. As this Nike ad aptly puts, your success has never been a long shot. Thank you, and I wish you all a wonderful spring and summer selling season.
Erin, thanks so much for joining us today. We know you're very busy, but always love having you on. Again, you will all be receiving a copy of this webinar by the end of this week. To those on the line, join us back here Tuesday, April 30th at 2 p.m. Eastern as Moss Adams talks to the Inflation Reduction Act and opportunities for auto dealers. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day.